Right now, the average person cannot afford the average house. There's an estimate that about 50% of the US population cannot afford a house over $250,000 in a time when housing prices, the average housing price, is above $400,000. So, how can the average person not afford a house that is almost $200,000 below the average without causing supply and demand to equalize? Because any time in history, any other time in history, supply and demand should meet, right? So if people cannot afford the prices that are currently in the market, what should happen to prices? Prices should come down. Yet Zillow and a lot of other analysts believe that prices are not going to come down, they're going to go up. Why? Well, let's talk about it. The first is undersupply. So what is happening right now, it's quite interesting, but you have a feeding frenzy in the lower portion of the market precisely because people cannot afford the average price house. So in the starter home market, let's say $250,000 and below, in that market, which is where the majority of people can afford houses, they're all fighting for the same small supply. So that is keeping those prices elevated. Okay, so then the next reasonable question would be, okay, but then why would the average home price be so high? Wouldn't those higher end houses come down to meet demand? In any other case, it would, but that is where interest rates come into play. Because interest rates are so much higher and they raised so fast, okay, compared to where they were even just 2 years ago, right? 2 years ago, interest rates were below 3%. Now they're above 6%. Okay, so that's a doubling. And it happened so quickly. It didn't happen over years. It happened over a few months. Now, what this did is it trapped higher end buyers. So the people who own the houses that are $400,000 and above, those people are trapped in mortgages that are 3% and below. So why would those people want to sell their house right now, especially when they have equity, right? Because they have equity built in the house because housing prices have gone crazy. Why would those people want to sell their house to move into another house with a much higher mortgage? So really the only people who can sell their house right now in that upper end of the market are people with a lot of equity, okay? The problem is those people can also afford another house of the same or equal price, which basically keeps prices elevated. So you have across the board, you have this weird scenario where you have undersupply across the board. And then in the starter home market, you have an undersupply of houses there, but you have a feeding frenzy of the majority of buyers trying to buy the lower end priced houses, these starter homes, which elevates those prices. All right. So you have starter homes that are going up in price because sellers can see that they can get more. They're having multiple bids, etc. Okay. Then on the other end of the spectrum, you have people in upper echelon houses, $400,000 and above, upper middle class houses that cannot sell because these people who make good money, they're not billionaires. They make good money, but they don't have unlimited money. So mortgage rates are still a factor to their decision because most of them have a mortgage on a house. And when you're going to sell and move into another house, you're going to basically start fresh with your mortgage for most people. Even if they bring equity along, they're going to start fresh in their mortgage. So you have people who do not want to get rid of their sub 3% mortgage to trade it for a 7% mortgage. Because a lot of times in that instance, they can afford less house, not more house. And those people do not want to afford less house. Most people in that upper echelon of the market want to move up market further. They bought a nice house, now they want a house with a pool, right? They bought a nice house, now they want a house with a bigger yard. They want to move up market. So on both sides of this real estate market, on both sides of the spectrum, you have pressure, which is driving housing up. Interest rates also play another part in this, and that is in the supply portion of the market. We have an undersupply of houses because we have an undersupply of builders building houses. Why? Well, one, COVID, unfortunately, wreaked havoc on the market, right? It wreaked havoc on the economy 2 years ago, and we're still feeling the supply chain issues. That's the first issue. So elevated prices across the board in building materials, etc. If you followed the market a couple years ago during this pandemic, wood lumber prices was like 2 to 3 times as much as it normally was. It was insane. Okay, so more than that, I think, more like 4 or 5 times. So we're still feeling those effects, not as much, but we're still feeling supply chain issues. But the major problem with builders is that now that the market has stabilized and maybe they have better affordable building materials, you have interest rates which are high. Interest rates again are high because we're trying to fight inflation. The Fed is trying to fight inflation. But remember, builders take loans out too. You and I are not the only people who take loans out. Okay? Businesses do take loans out to fund their ventures. Builders take loans out to buy materials to build houses. Okay? So you have an undersupply because of interest rates. You have an undersupply on the starter home market. One, because prices keep rising, and two, because the builders are not funneling building homes into that sector of the market. Builders are instead focusing on higher end homes where there is a higher profit margin because they have to make up for their high interest rates that they are paying. Okay, so all in all, the issues that we're facing in the market have to do primarily with the repercussions that we are still feeling from the pandemic. And on top of that, because we printed so much money as a country, whether you agree with the decision or not, I'm not here to argue politics. What I'm here to talk about is economics. And at the end of the day, the fact of the matter, whether printing the money was required or not, whether printing the money was the only way to avert disaster or not, that can be topic for a separate video. The point is, we printed trillions of dollars, which caused inflation. And now, 3 years later, we are trying to fight that inflation. And all the repercussions that you are seeing in the market come from that. If you try to peel back and look before 2020, the market, we had problems. We had up markets, we have down markets, we had stock markets that rose, and we had stock markets that crashed. But overall, from 2008, the last major recession, to around 2020, the markets moved in the right direction for the most part. Now, maybe not perfectly, but they did move in the right direction. 2020 happened, and this pandemic happened, and whether we believe it was overblown or not now, I'm not here to talk about that. The fact of the matter is we printed a shit ton of money, and that shit ton of money printing has consequences, and we're facing those consequences now. So when will houses become affordable for the average person? Because you either own a house and you want to upgrade, or you haven't bought a house yet and you want to buy a house. So for you, and maybe you're saying also, look at the rental market. The rental market is insane too. All this is because of undersupply. So when will the market stabilize, and when will you be able to afford a house? Well, a few things need to happen. Either A, your salary needs to increase dramatically. Now, I'm not even going to try to touch on if that's ever going to happen. Look, corporations have a prerogative to keep costs down and to return money where? To the shareholders. The whole point of a corporation is to make a profit for their shareholders. So your salary is an expense to a corporation. So there's always a constant battle between raising salaries and providing profit to shareholders. So unless your salary rises dramatically, which is an option on the table, I'd very low chance that will happen in the next couple of years. Unless your salary rises dramatically, the only other option is for builders to start building where there is more of a supply and where supply and demand can meet. Because until that happens, when there is more demand than there is supply, prices are going to go up. So until that equalizes and potentially even tips into the favor of supply, where you have a move downward in prices, because if there's more supply than demand, prices do what? They move down to equalize. Supply and demand is a real thing, and it does work. And there are instances where it doesn't, and there are instances where monopolies can try to control prices. I understand that. But in a free market that is working, and we have to assume that we have a relatively working market, supply and demand does work. And right now we are having a major demand over supply issue. So how does that happen? How does supply start to overtake demand? Well, interest rates matter. So inflation matters. So until inflation is under control, or until inflation is where the Fed wants it, they will not lower interest rates. And until interest rates are lowered, builders are going to have a harder time than usual building. I'm not saying they can't build. People are building all over the place, but it is still not enough. So until builders can build freely and have the financing to boost the economy, right? Because remember, low interest rates in general spur economic growth. High interest rates shrink economic growth. And we are seeing this play out in real time in the real estate market. So until interest rates come down, because inflation is where the Fed wants it, we're going to have a tough time in the real estate market, and real estate is only going to go in one direction, and that is up. So do I foresee this happening in the near future? First and foremost, I want to say, like always, I don't have a fucking magic 8-ball. All I can do is make presumptions, not assumptions, based on data. That's all we can do, right? Assumptions are just making guesses. Presumptions are making educated guesses based on data, and that is what we can do. Inflation seems to be coming down. Inflation does seem to be going in the right direction, which is down. So if that continues to hold true, 2023 should be the end of major rate hikes from the Fed, and 2024 should see, hopefully, a reversal in policy. But that only holds true if inflation continues moving in the right direction. If at any point we get sticky inflation, there's going to be a problem, okay? So interest rates have to come down because inflation needs to continue moving in the right direction. If that does not happen, builders are going to have a hard time building, and when they get financing for building, they're going to want to recoup their money, and they're going to want to make a profit. And that is why you see a lot of building in the higher, I don't want to say the higher end, but the middle to higher end market, right? $500,000 houses. But you don't see much building in the starter home market. So until we get inflation under control, we're going to be in trouble in the real estate market. Now, if you own a house, fantastic. Your equity is going up. But even to you have to understand that if people cannot afford to buy your house, your equity is just net worth on paper. It's not real net worth. You have to have liquid assets that are sellable to be able to actually consider that net worth real. So across the board, it is always better when people can buy houses, right? It is not a good situation where people cannot afford to buy houses. Now, right now we're having that type of situation, and it all comes down to the repercussions of printing a fuck ton of money. Okay. Now, don't get me started on the budget. Don't get me started on the budget deficit. Don't get me started on the amount of debt that this country has. Those are topics for another video, but they're all interrelated. And that is why finance is so important to learn, personal finance as well as economics in general, because you start to understand how finance works and how everything is related, right? Everything is interconnected. And when you pull a lever here, it affects things here. No matter what it is. When you pull a lever here, it affects things here. That is just how the market works. And you need to understand that in order to make the best financial decisions. Because if you are narrowly focused on the real estate market and you don't see everything that's going on around you, you're not going to make the best decision as opposed to someone who understands that everything is interconnected. So macroeconomics affect microeconomics. And personal finance is affected by both of those and by the decisions of your government and my government. All right. So I hope I didn't ramble too much. I hope I didn't take away your hope. I do think that things will get better. I'm a little bit more optimistic in 2024. I think things will get better as long as inflation keeps coming down. I say this every video. As long as inflation keeps coming down and as long as we avoid not a minor recession, but a major recession. If we have a minor recession that's short-lived, whatever. But we need to avoid a major recession. As long as we can do that, I think 2024 is looking better. So I don't want to take away your hope. I do think that eventually salaries will rise. I've noticed that salaries rise slowly because it is always a fight between corporations and employees as to raising salaries, because a corporation sees it as an expense and an employee sees it as a livelihood. So there's always that battle. But I do think salaries will continue to increase. They have, and they will continue at a slow pace, okay? And I do think that inflation will hopefully come under control by the end of 2023, early 2024 at the latest. And I hope that the Fed will then, and I do see this happening, the Fed starts to at least stop raising interest rates and hopefully starts to change direction and bring interest rates down. So I don't want to take your hope. I just want to be real with you. And from what I'm seeing, this is what's going on in the real estate market. And until we get a shift in interest rates, there's going to be an undersupply and an overdemand situation. And when that is the situation, buyers suffer because they can't afford houses, yet housing prices doesn't come down. And that's exactly what's going on because of the ramifications and the fucking repercussions of printing a literal ton of money over the last 3 years. Okay? My name is Derek, and I got my degree in finance. You don't have to. If you like personal finance, if you like economics, if you like things like this just broken down, and if you like having discussions about these types of things, you're in the right place, because that's all we do here. We talk about personal finance, about investing, and about economics every single day. I love this stuff. It's been my passion for over a decade, and I love being able to ramble and share this with you guys. And I hope that my rambling teaches you something. I hope that you truly get something out of every single video. And even if it's just a smidgen, even if it's just a tiny little bit of information, if you learn just one thing with my 10, 15-minute video, if you just learn one thing, that makes me happy, because I know that that'll make your life better, because personal finance does affect your future. Whether you want to believe it or not, personal finance is the main driving factor as to whether you retire early or not, and as to whether you make a lot of money or not. Personal finance is that cornerstone that is behind the scenes, that is driving your economic and financial vehicle. So learn it, because it's important. Again, I love you guys. This stuff's been my passion for a decade, and I love being able to share this with you guys. And I will see you in the next video. I hope that next year, everyone who wants a house will be able to afford it. And if not next year, the following year. I'll see you in the next video.